Hello, everybody. My name is Michael, and welcome to my channel where I talk about stocks that I think are interesting. And if you think that's interesting, then please consider liking this video and subscribing. And also, please consider following me on Seeking Alpha, the platform we're looking at here, where I regularly will publish articles of my analysis. And frankly, um, my written analysis is probably better than me fleshing it out here on the camera, mainly because I have more time to prepare. These videos are me kind of going through each piece of the analysis visually, mainly to give you insight into how I think. And the hope there is that you not only find it entertaining, but useful, and hopefully that it might, give you some methods to consider when evaluating your own investments. As always, this is not a recommendation to buy or sell a security. Please do your own research. Investing in stocks and anything really comes with risks. All right, let's get into it. So today I'm going to be talking about a company called Carlisle Companies Incorporated, ticker CSL. It's a mid-cap company with a $17 billion market cap. You may have heard of it if you're in the construction industry. Otherwise, probably flown under the radar. It's been around for a long, long time. And interestingly, here, just a quick note, 46 years of increasing dividends, according to the website, 47, according to Seeking Alpha. So, yes, this company is a dividend aristocrat. In fact, it is on the cusp of being a dividend king with 50 plus years of dividend increases. But is it a good deal right now? We will discuss that. So, as always, I'll describe the company, talk about the moat that it might have. I'll talk about the narrative around what's driving the price. I'll do an analysis of the financials, the valuation. We'll take a look at the dividend metrics. We'll discuss some of the risks. And I will give it a grade, buy, sell, or hold, and we will take a look at the chart lastly. So let's jump into it. So this company is a pure play on building envelope materials, and the building envelope is exactly what it sounds like. It's the exterior of a building. So that might mean the siding, that might mean the roof, any sort of exterior sort of system on the building would qualify as the building envelope. It's more depending on the type of building that it is. You think about if you're a developer of big, rectangular, flat-sided box buildings like warehouses. You're not putting a shingled roof on the top of that. You're putting down like what might be called like a TPO, like a rubber membrane that keeps the water from permeating the surface. You could maybe imagine how with a building that's very uniform in its dimensions, like a warehouse, how there is kind of an opportunity for a business to integrate itself around multiple levels of the value chain there, siding, roofing, and so on and so forth. So I will qualify at the beginning of this video by saying that I'm not a building envelope expert. That's probably apparent by listening to me talk. If there are things that I don't fully understand and you do know, please, weigh in, comment. The idea here is that there's a very, very interesting growth story. And this company, it's also a demonstrable track record of success story. So here's the thing about construction. I think I think we all know that construction is fairly cyclical. It's dependent on economic growth. It's dependent on, household formation for residential construction, industrial growth for industrial construction, and of course, again, really household formation or population growth in a local area. It does drive a lot of construction demand. Common sense wise, in my mind. So, do I like companies that do construction? No, not really. I don't love the industry. I don't like the industry for multiple reasons. However, this company has very, very, very robust financial performance and just a very, very good track record of results. Um, so I do have this company. I do have shares of it. Um, if you've been watching my videos, I've only been doing these videos for about 7 or 8 weeks now. You may notice that uh, pretty much all of the videos are companies that that I already own. And the reason behind that is because they're businesses that I've analyzed already, or that I understand better than ones that I don't own. So no, I'm not trying to pump my bags or anything like that. It's it's because it's just kind of low hanging fruit. I there's no shelf life to me continuing to make these videos. So if it feels like I'm only talking about stocks I own, that one is not always the case. Anyways, enough tangents. Let's talk about this company. Um, so recently, and by recently I mean really within the last several years, what they have decided to do is pivot their business away from being a diversified industrial conglomerate into a pure play building products business. Okay, so here in 2006, they say $2.6 billion revenue on a diversified platform managed with 9 distinct business units. Here, construction materials being 43%, tire and wheel 24%, food service products, power transmission, brake. So yeah, motion control. I just covered Parker Hannifin. They do motion control. This business was in that. They might have even sold some of their units to Parker Hannifin or similar. You see here, 10 years later, from 2006, them pivoting further, getting more concentrated in the construction materials business. They say here, consolidated platform segmented into 5 distinct business units. So we go from 43% to 56% construction materials, interconnect technologies, telecommunications, food service, fluid technologies. Okay, so they're still diversified. Well, here we go to $6.6 billion. This is as recent as 2022. 83% of current revenue is derived from building products. They still have this fluid technologies business, however, 59% construction materials, but this new business here, weatherproofing technologies. So, why are they concentrating their business further? Like, isn't it good to have diversification? Isn't that what they should be doing? Right? Well, no, not necessarily. And here's the thing: I watched they on the main page of their website. They have this thing called this video about Vision 2030. So what they do is every 5 to 7 years, this company comes out with their Vision X, vision for 7 years in the future, and they lay out their plans. Well, in this video, they talked about how the Vision 2025 plan that they created in 2018, they decided that they were going to pivot their business into 100% building products, 100% building envelope. And why? Well, they explain why. Hold on, I'm getting a call. Screen the call. Nothing's as important as this, all right? So I'll just take this opportunity to kind of side quest for a moment and discuss ROIC, returns on invested capital. So, returns on invested capital are what drive stock price returns, right? Because uh, every business has a cost of capital. They, issue debt. They People pay in their equity dollars, right, to fund the business, and people buy shares like we do as investors, right? We buy equity shares. Well, there's a certain expectation of a return on those equity shares. So there's a cost of our equity dollars being invested. There's a cost of that management must return to us in the form of price appreciation, dividends, and share buybacks. So in order to achieve stock price returns and create value for shareholders, the business must generate returns on invested capital far above the cost of capital, meaning the weighted average cost of debt plus equity, right? So if you've been investing for a while, that's obvious to you. If you're newer to the game, return on invested capital is very important, okay? And what I'm gathering about this company is that the management team, first off, they're highly competent, and we'll see why in a moment when we look at their financials. So we're not going to do that because all I wanted to do was highlight this. Return on invested capital, they are very closely monitoring ROIC of each respective business unit, right? And that's pretty smart because it's driving their capital allocation decisions. So basically what they found was that for their buildings products business, they were achieving and have been achieving excess of 25% returns on invested capital, um, which in 2016 their ROIC was lower than that, right? So pretty straightforward. If they concentrate their portfolio on the highest returning business lines, they should, in theory, drive more shareholder returns. And so that's the idea behind the pivot. They call it the Premier Building Products Platform. In fact, they're trying to get 100% of revenue expected to be derived from building products business 2024, right? And the reason for that being that they achieve higher returns on invested capital. So that is notable when it comes to analyzing this company. So in terms of what they are, right? In terms of what they are, they sell kind of like Parker Hannifin, but even more I don't even know the right word to describe what I'm thinking. They sell materials that are used to construct or renovate or upgrade buildings. So, what drives growth? Household formation, real estate development, GDP growth, but also capital expenditures due to pent up demand. If in a given area all the buildings are 30 years old and none of them have replaced a TPO roof, there's a ton of capex demand that's about to hit. So they benefit from new construction. They benefit from buildings being old enough that they need to be upcycled in terms of their capital expenditures. Do I want a ton of exposure to that industry? Honestly, not really. However, this company is a very, very strong performer. And so we will go into that in a moment. So, do they have a moat? It's hard for me to wrap my head around what might create a moat. It does not seem like it is a moaty, maybe if they're fully integrated along the value chain of each of the respective products, that creates kind of like a narrow moat around that business line. But I don't see how it's that hard to replicate building envelope products. So I'm going to refrain from weighing in too much on the moat. It seems common sense wise to me that this company, it does not have the products they sell are not moaty. Any moat that they might derive comes from integration up and down the value chain or and around the value chain of that item. Um, for example, this was 2 weeks ago. They're acquiring this company, Thermofoam, Texas-based polystyrene insulation manufacturer. Some press release I read about this somewhere said that they were vertically integrated. Thermofoam, vertically integrated. Either way, the purpose of business is not necessarily to create a moat, it's to create high returns on invested capital, right? That's the idea. Moat help the longevity of high returns on invested capital. So anyways, what's driving the price? Well, we see here the stock's actually really sold off quite a bit lately. In fact, November 25th, it was practically at an all-time high. The all-time high here was in October, $480 a share. It's basically been in just a downslide since then, 20 something percent, over 20% down from the all-time high. What's driving that? Well, again, remember what we have exposure to here. We have exposure to construction. Construction is exposed to real estate. Real estate is exposed to interest rates. What has happened to interest rates in the last few weeks? Well, they've shot up, right? They've shot up because of inflation expectations have been revised upwards. The bond market is pricing the possibility of a policy error from the Fed. They've been lowering rates, but inflation has been sticky. It hasn't been coming down as much as it should. In fact, the bond market is even seems to be pricing in the likelihood that they will raise rates again this year or the following year. So if I had to guess why the stock has sold off, it would be that. It would be macroeconomic factors that don't necessarily have anything to do with their exact business. That this company it has correlation to real estate driven market forces, interest rates. I've got a couple of real estate investment trusts in my portfolio. They have also sold off with a similar bent in that time frame, right? So that's really what's driving the price. If I had to guess, when I say that when I talk about what's driving the price, I don't know for sure. None of us do. That's just my guess. So, is it a well-performing company, though? Well, let's take a look. Let's take a look at these financials. Okay. On an annualized basis, revenues 3.2 to 5 million. Okay, so that's 40 something percent. No, 50, more than 50%. Pretty good. Gross profit 831 million to 1.9. So gross profits are increasing much faster than revenues. Operating income 420 million to 1.2 billion. Operating income is growing very quickly relative to gross profit, relative to revenues. That looks highly efficient. In fact, earnings from continuing operations, we normally don't pay attention to this because these are kind of all of the financial items, taxes, interest, investment income. I usually don't account for those, but even then, we're going from 250 million to 900 million. So even earnings from continuing operations are accelerating faster than operating income. Net income to company, net margins 250 million to 1.35. That's over a 400% increase. Earnings per share. Here's where it gets sexy, folks. Earnings per share 389 to 28.57. 7 times 28.57 divided. How is earnings per share growing so fast compared to profit? 65 million shares to 47 million. Over a quarter of the shares have been retired in 10 years. Shareholder returns. Dividends per share from 94 cents to 355, 3.5 times, 250% dividend growth over 10 years. That does appear to be growing less than earnings per share. Therefore, yes, the payout ratio is actually lower. Payout ratio is very low. This looks great, guys. It's great looking income statement. Okay, let's take a look at their balance sheet. 1.5 billion of cash, 800 million receivables, 1.9 billion of debt, of which 400 million is current. They're pretty flush with cash. I mean, they almost have enough cash to pay off the entirety of their debt. And how much EBITDA are they making? I mean, they between the cash that they have and the amount of cash they generate, there's more than enough there to just pay off all their debt within less than a year. So the balance sheet looks really good, really healthy balance sheet. Retained earnings has going, so they're not over leveraging. Their retained earnings look good. They're not, in other words, they're not issuing debt just to pay dividends and stuff. Plenty of cash per share. Really good looking financials. Let's look at their dividend. Okay, 47 years of growth. So they're practically a dividend king. Here's what's interesting about that. The low payout ratio and 15% compound annual growth rate over 5 years. Wow, that's really good. Rarely do you see a company that's so old, it's been around so long, grow dividends so fast. But, I mean, let's just look at this dividend history. 25, that's like 20%. That's almost 20%. Gets a lot slower there. It's like 7%. 25% right there. 6%. 2% right here. And then boom, they raised the dividend by almost 50% in 2022. Very strong dividend growth. Let's take a look at the yield. Definitely on the current yield is on the lower end of where we've seen it. We've seen it dip as low as 75 basis points. It does appear that most of the time it's hovering above. This is over 10 years. Most of the time it's hovering at like 1.25%. Right now it's right around 1. Not bad. It doesn't look egregiously overvalued on a yield basis relative to its history. If you would have bought it 30 years ago, you'd be making 46% a year. Stonks. Here's something really interesting. Free cash flow yield above 5%. That's great. Slightly below the historical average over the last 5 years, but not really. I got to tell you, I've looked at a lot of companies. Obviously, I have not seen in a while, I have not seen a company that is trading at that high of a free cash flow yield that is growing as fast as this one is. At least has grown as fast as it has the last few years. I mean, that is a great cat. That's higher than the 10-year treasury. What about some of the more standard uh, valuation metrics here? Um, price earnings less than 20, around 20, less than 20. That's pretty good. Um, price per sales is a little high. Earnings growth looks pretty good. Looks really good. Here's the thing, guys. This company is, if we just ignore what it does for a second and we talk about the numbers that we're looking at here, it looks exceptional. Outstanding performance. They've got this pivot, right? And this year here is 2016. So the majority of these results, all these results we're looking at have been in the context of pretty much from this period to this period. So what happens after the transformation is complete, of which it was supposed to be last year, right? What happens then? I mean, those numbers just look phenomenal to me. Very, very good looking financials. I have a hard time. Here's where numbers meet emotion. I have a hard time believing that there's a long-term growth story here for building envelope products. Because what about population growth? Isn't population growth slowing down? Isn't household formation growth slowing down? Maybe there's the story behind upcycling all the capex that needs to happen. Okay, you got me there. But the numbers of this business look so good. They look good enough that I've entered a position. I entered a position last year, but it's not a big position relative to some of my others. And but the financial performance and the numbers of this stock look a lot better than many other stocks I actually have stronger conviction in than this one. So that's the point where you ask yourself, where I ask myself, am I stupid? Like, is this one of the best investment opportunities I've seen in the current market? Based on the numbers, it's definitely in the upper decile, the upper quartile things, just numbers wise. The end market, I have a hard time reconciling that. But that is an emotional reaction, right? And I think it's important to distance somewhat. There's nothing controversial about what they sell. There's nothing unethical about it. There's nothing, I won't invest in pharmaceutical companies, not because I believe they're bad businesses necessarily, but because I don't like how they make money. I don't have those concerns with this. Okay. So here's the deal. Phenomenal looking financials, and the current valuation looks exceptionally good to me. What about relative? That's a fair valuation where it is now, just relatively speaking. The yield wasn't too high. The valuation isn't too high. It does look like it's gone up slightly over time, like all stocks, but less than 20 earnings per share ratio on a stock growing this quick. That's really sexy, guys. I'm not urging you to buy this, but I will say those numbers look really good. If they continue growing the dividend like they have, I mean, wow. 15 cents on 85. I mean, that's more than 15% that they raised it by last time. What other stock in my portfolio is raising dividends that quickly? MasterCard is the first one that comes to mind. Well, MasterCard is trading at a 33 to 34 forward PE and has a yield of 0.5%. So it's effectively, I have to pay double to get those cash flows than I do this. Now, objectively, MasterCard's probably a much better business than this. What I'm looking at here is I'm looking at a company that does appear to be exceptionally well managed, right? And that means something. So, where does the growth come from? It comes from the fact that they're realigning their business based on a smart measurement of financial performance. The fact that they're focusing on returns on invested capital, I think, is really smart. I like that a lot. And they're driving these acquisitions. Now, there's really no mention of the numbers behind this acquisition. Located in DFW, Thermofoam serves the commercial, residential, and infrastructure construction markets. The acquisition of Thermofoam builds on our recently completed acquisition of Plastifab, leverages the vertically integrated, expanded polystyrene capabilities of our EPS business while adding scale, supporting retail channel growth, and providing valuable geographic coverage. I don't know. There's a lot to be excited about there. And let's just take a look at some of their earnings, projected growth in the low double digits. One of these had a financial. Okay, here's what we need. In 2012, okay, so 2.3 out of 3 billion of growth came organically. EBITDA margin expanded by 900 basis points. Returned on capital expanded by 800 basis points. That's just driven by their reorganization, I think. Let's look at this. ESG megatrends. I'm trying to find some way to justify here, where is the growth come from? Because my mind tells me that it's looking really good, but I'm just so hesitant to get really excited about it because I have a bias against construction, right? So I'm trying to be open-minded here. Again, I already own shares, but after it's been a few months since I've looked at this, at least, and I'm kind of blown away by how good those numbers look relative to all the stocks I've covered in all these videos lately. In order to meet climate targets, there's increasing demand for energy efficient products to significantly reduce the greater than 30% of global annual greenhouse gas emissions from buildings. Carlisle experience and earning price. Building products businesses generate highly resilient EBITDA during economic downturns. So this is revenue and this is EBITDA. Okay, so basically what they're saying is they're so good at managing their company that even when their revenue is decreasing due to downturns, which happened here, I mean, revenue goes down 20% here, but margins go up 400 bips. EBITDA is the same. Here, revenue goes down almost 10%, but EBITDA goes up. Margins are up 200 bips. Another theme here is margins are just climbing up. So look, I don't know what these guys are doing, but clearly they're doing a good job. Okay. So what I'm looking at here is I don't love the industry that they're in, and frankly, I don't understand it probably like I should. But this company looks like a compounder to me, and it looks like it's very, very well managed. And there's enough value there, especially the relative valuation. Seeking Alpha is giving it a D plus valuation wise. I think it looks really good. I would give it a much higher grade valuation wise, and furthermore, I would grade this a buy, borderline strong buy. It just the numbers look good. I want to get out of my own way mentally on this one. I think it's a really, really good looking stock for sure. I actually really like how it's not very big too. 17 billion. Again, my simple brain makes me feel like there's a lot of runway left there. In this video here, they're somewhere along the line. I wonder if I can find it. Yeah, right here. They talk about the addressable market. Okay, I want you to watch this. Here we go. I just missed it. Okay, so this video is a year old. They've grown their revenue since then. We know their market cap is 16 billion, 4x sales, let's call it. Okay, a little bit less than that. There is a big runway there. There is a big runway there. If we take what the CEO, this is the CEO, if we take what he's saying at face value and we say that is the size of the addressable market, and what they already what they're already working on has a $30 billion addressable market plus what they refer to as the adjacent opportunities. That just kind of gives weight to there might be there might be some runway left there, right? Again, the way we look at that, if this company controlled 100% of the market, in other words, if they had $70 billion of sales and they were priced at the same price to sales ratio they're priced at now, very simple analysis, 3.5. That's like a $250 billion market cap, right? I mean that's a 15 bagger from here, right? They're never going to control 100% of the market, right? They're never going to control 100% of the market, but just to give you an idea, again, it helps me to see that kind of information because I'm not a construction person. I don't understand fully this market, but this is a very interesting and compelling looking opportunity. And clearly I've been comfortable enough to buy a few shares. However, I'm becoming more interested now as I'm diving into it deeper in real time. What are the risks? Well, I think the risks are there's a lot of execution risk behind what they're doing. They're pivoting their business. So they have to get a lot of things right. Now, what kind of makes me feel okay about that risk is the current management team has been in place for a while. They talked about their tenure at the beginning of that video, which you didn't see, and have a demonstrable track record of success. In fact, they achieved the targets in their 2025 Vision 2025. He's the CEO said that they achieved them 3 years early, right? So phenomenally managed, phenomenal execution. Okay, so there is always execution risk with every company, but especially with what they're doing here, there's maybe elevated. However, the management team does appear to be highly competent, highly knowledgeable, and very good at what they do. Other risks, honestly, I think again, this is the thing I've been bothered about the whole time is just construction. Um, I have a hard time with believing that construction is going to be a great place to be for the long term. It might be. Of course, I could be wrong about that. However, if companies like this are executing and growing their market share, they will do well. This is the only building or construction, focused asset that I have in my portfolio aside from just real estate or real estate investment trusts. And frankly, if I'm worried about construction, maybe I should be worried about the long-term aspects of real estate, right? So there's a qualifier there. But I think that risk, it's more of like my fear brain talking than something that I can actually quantify. Now, something that we can quantify is the demographic trends of a lot of advanced economies are not good right now, and population growth is slowing. However, that's not happening in more developed nations. Maybe there's a lot longer runway for this company internationally than I'm giving it credit for. In fact, it does say that it operates in every continent: United States, Europe, North America, Asia, Middle East, Africa, and internationally. Okay, well, then again, I think that somewhat mitigates the risk or minimizes it in my mind. The fact that they are operating internationally, there's some modest currency risk there. I think the main risk the main, most obvious risk here with this company is that it's cyclical. It's cyclical. You're not going to ride out a recession in the stock price. Now they did have that. They have this chart here. Their underlying financial performance is very good, relatively good in downturns, but what about their stock price, right? What does their stock price look like? Well, here, just like any stock, they sold off 40% in the COVID crash. Here, from 48 to 21 to 18. I mean, 60% drawdown in the GFC. This isn't a safe place to hide in a drawdown. I mean, even in the 2022 bear market, from 300 close to 200 a share, for 40 to 50% drawdown just in a couple years ago. It's not a safe place to hide. It has a beta higher than 1, I would imagine, and it's more volatile than the index for sure. Just crushing the market. So yeah, I think the main risk with this stock is that it's a volatile stock. It's cyclical and exposed to the business cycle very directly. Construction stocks don't do well in recessions. This stock should be looked at as no exception to that. It actually did outperform here. It looks like. Not bad. Let's look at the chart really quick before we conclude. Just a 5-year chart. Just outstanding performance here. I don't know about you guys, but it looks like it might be a good time to enter if you're considering entering a position. In fact, the moving averages crossed here. It fell just right through that floor. Is there further downside? Maybe. As always, very much maybe. I mean, here it bounced off the trend and just fell right through. Could it do that again? Absolutely. But, there are worse times to enter a stock than right here. There's a pretty basic trend line here, and it's right there. The last trading day, it was up 2%, bouncing. Does that mean anything? No. But honestly, this looks like a bona fide entry point to me. I wouldn't put your whole portfolio in it, but yeah, that looks like a decent setup right there. Technically, there's my very sophisticated technical analysis. So just to sum it all up, I have a hard time liking this company just based on what they sell and what they do. However, the financial performance is very, very good. Some of the best that I've looked at lately, especially when compared to the valuation. The valuation seems very fair to me. Maybe the valuation seeming that way is just because they're not a Modi stock and therefore they don't deserve a premium valuation. That's probably fair. However, their operational efficiency is very, very good. So if they don't have a Modi business, then they have excellent managers and an excellent culture. I really, really like what I see in the numbers. I'm almost ashamed at how much I like it because I don't want to like it. Okay. But I do, and it's very good looking. So I assign this a buy, borderline strong buy. Again, objectively, it is a strong buy, I think. For me, it's not a strong buy just because I am not being very aggressive right now in accumulating growth stocks, of which this is a growth stock. I would prefer to put more capital into value stocks. This seems like more of a growth play to me. Therefore, I really don't want to like the idea of allocating more of my portfolio into it. But after deep diving into the numbers, I'm definitely going to give it a stronger consideration. But as always, I'm just a voice on the internet with lackluster ideas. So please do not buy or sell a security because I think it's a good idea. Please do your own research, use your own methods, and rely upon your own intuition when making decisions. That's what I've done over the years, and it's worked well for me. So I hope that you found this video interesting. I've certainly had a good time making it and working on it for you. And let me know what you think about this, comment, write to me, whatever. I will write an article about this company. It's very interesting. There's a lot to discuss with it. So definitely make sure you follow me and check that out. And I will look forward to presenting you with more of these analyses in the hopes that you enjoy them. I really appreciate you spending so much time watching my video today, and I hope you found it useful. And until next time, I will sign off now. All right. Thank you. Bye.